The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, you want to know what's going to happen in the stock market next week?
I'd love to know.
So do we.
Yeah.
So everybody thought the market would just go skyrocket once Powell spoke and said that he was going to cut interest rates. And, well, that was kind of a nothing.
Not quite.
Sandwich.
Yeah.
Well, everybody been betting on the interest rates coming down. And he said, well, things are slowing. It looks like things are getting better and we're getting closer. But he didn't tell us when or how much. So those two issues are still unknown. And when we get it through next week, we won't know what the next week ahead looks like either. I mean, the fact is, forecasting the stock market remains a mysterious goal. Everybody's got a goal, but nobody has an answer.
Right.
We learn from history, and one of those major lessons of becoming overconfident in your personal view of the future, we have to go back to the 20s with Irving Fisher, who became a well-known economist with a well-known bad stock market forecast after years of being pretty decent. But that's the way life goes. Probably not familiar with Irving Fisher, but he was an economist, and he figured out some math that really helped him with the change in the economy between 1912 and 1913, and it developed notoriety. He developed a large following, people looking for his math to tell them what the economy would do, and by implication, what the stock market would do. And he began to believe that he could forecast the stock market. And he did in 1929. And he's if you read any financial history, you're going to run across this. 1929, he wrote, actually he was making a speech in New York City on October 15th. And quoting him, stock prices have reached what looks like a permanently high plateau. I expect to see the stock market a good deal higher than it is today within a few months. Well, 2 weeks later.
You want to talk about being on the wrong side of a call? That's the wrong side of a call. And he was certain that he was doing this right. He's verified, like you said, Don, he's verified his process. The math works. I understand what's going on here. And, it's like one of the oldest sayings, in the stock market game is, never confuse brains with a bull market. And as long as the market was going up, Fisher had it nailed. And prediction after prediction kept coming true. And so, as we tend to do, he just extrapolated that on out in the future as far as he could see and said, as far as I can see, this is good and is going to continue to get better and it's going to stay that way. That's where we're headed here. And there were a lot of people that just took what he said as gospel and ran with it. And that was very unfortunate because they were obviously completely wrong as the market tanked.
Yeah, it was it was a disaster. But he was so convinced that he was right that he borrowed, when he got a margin call, because he had borrowed money and bought Remington Rand. When the stock price went down, the bank called and said, you got to put more money in or sell some stock. And he knew he was right because he had a track record of a couple of years. So he borrowed money from the family, covered the bank, and bought more stock at a lower price because it was a better value. And you've heard that before. If you've been in the market
Yep.
any time at all, prices come down and people say, well, it's a better value today. It's certainly a lot cheaper than it was when I bought it before, so I'll buy some more. The problem with that is you don't know how low is until low quits becoming lower. And
That's
that
it.
was the problem for Mr. Fisher. He continued to buy. Eventually, he ended up broke. He, his mansion had
Lost
to be
everything.
sold. I mean, he had nothing left. It's a sad, sad tale.
And it's quite common. It happens all the time. People begin to believe themselves that we have an insight here. We've got this figured out. We know how this is going to work. And so the fact that I have to pony up more money means nothing except that I'm going to be wealthier a year or two from now, more than I am now. This is even better. Let's buy more. And that's how dedicated you become. And you're actually just telling yourself a big lie. And if you open your eyes and look at it and say, you know what, I'm losing money hand over fist here. Nothing is working like I thought it was going to, and make a move based on that instead of the belief that I can't be wrong. I can't be wrong. This has got to be this. I've got to be correct. And so what I need to do here is double down as quickly as I can because I'm about to become intensely wealthy because I am so smart and this is going to make me look like a genius. And you can't get out of your own way at that point. You're trapped. You trapped yourself, and you listen to your own headlines saying how great your last prediction was. And it doesn't matter if you've been doing it for a week or a year or a decade. You cannot begin to believe that you know more than everyone else in the market, including the market itself. And we've heard that so many. Well, the market's wrong here. Everything should be going up and it's going down. This is a mistake. It's like the market is not making a mistake. The market is disagreeing with your point of view, and it can do it for a long, long time. And you cannot just say, I'm just going to hold on to this because I know I'm going to be right, unless you have almost unlimited funds, because it will drain you dry and you come out on the losing end.
Perry, what comes to mind is a conversation I had a decade or so ago with a client who at the time was a younger and newer client. And he asked the question, he's looking at my library. I mean, I have two bookcases in my office that are full of financial books. And he looked at my library and said, well, which one of those should I read to figure out how to run my own account? I said, well,
right.
you just pick one. I mean, that's just a starting point. There is no single book. There is no single process. It's a combination. There's of multiple factors that you can rely on. The question is, what are you going to do to make the decision? What's your process? What are you going to look at?
Right.
And that generally requires that you spend some time trying to figure out what the different indicators are, what different trends are. You have to reach a point where you say, this process sometimes is going to be wrong, but I can live with that because more often than not, it will be right. And that's the way the market is. I mean, three-quarters of the time the market's up and the other quarter of the time it is not. And what are you going to do during that period of time? Well, Irving Fisher just knew that the market was wrong and he was right until he was broke. And that's part of the risk of using margin, borrowing money to make an investment, particularly if it isn't working. Now, if you're margining money, borrowing money to margin your account in an uptrend, as long as you have tight stop losses, it can add to your return. But you can't do that and then sit back on your recliner and say everything's going to be okay, because it will only take something like the collapse of the yen carry trade that happened this last month to just blow up your entire investment. Not only blew it up for a couple of weeks, but if you had a margin call in the meantime, you were taking losses. You were either taking them by selling low, or you were funneling money in from another account, which means that account was taking a loss because it's worth less money. So
that's correct. And don't forget how fast things happen today. Mr. Fisher, back in 1929, we were still looking at, physical paper trading. Everything happened very slowly and as orderly as they could make it. These days, it's 100% electronic, computer driven, and it happens fast. So when you're wrong, the market moves against you very, very quickly. So if you're out there leveraged, you cannot ignore how much that increases your risk of loss. And if it's coming, it's going to come quickly. It's going to just roll over you so fast. You really need to be uh, um, sure that you're willing to take the risk and ready to recognize the loss, because usually when it hits, there's no way to avoid it. When that yen carry trade, Tom, you were talking about, collapsed, boy, the biggest traders on Wall Street, big hedge funds, they were selling like crazy, trying to get out of the way, because even the smartest people in the room, they were on the wrong side of that trade, and they had to make adjustments today, instantly, and they were moving it. They were moving that stuff, shoveling it as fast as they could get it out of their portfolio, and it still cost them money. They were just trying to make it cost them less, and that's why it can be so dangerous to, especially when you're in a high risk situation, to believe, nope, I know what's going to happen. I understand the position the market's in, and I know which way this is going to move. You don't. Things happen that no one ever foresaw all the time, now more than ever, because things happen so quickly, and things that you would never think about can affect the market greatly. And you really have to be willing to look at the data, which is why we are never in the prediction business. We never try to make a forecast and say, well, next quarter, small cap's where it's at. Let's load up on small cap. Here we go. Never. You look at the data, you follow the money. You don't try to tell the market where it's going to make money next. It's a loser's game.
So let's, I got a couple of charts up here. Let's share those. So the difference here is that we don't know where the market's going to go, but if we take a look at the ETF for the S&P 500, what we can see here is that what I've marked out is a kind of a trading band. This is a range of major trades for the last couple of months. So we've had some upward progress, but the rate of change has slowed down. Back here in October, November, this was pretty rapid, and it rolled over, slowed down, gave some back. And this rate of ascent is a little bit slower. This one's pretty fast right now, and it's pushing right up next to the all-time high. So if there's good news in the market, when we have a catalyst that gives investors a new sense of optimism, they'll pile into this and can push it up to new highs. The problem is there's been a lot of speculation in this last month's run, and the question is whether or not earnings really justify that. And probably this week, I don't know when this podcast is going to get posted, but this week's earnings from NVIDIA is probably the catalyst that's going to determine whether we go higher or come back and test some of these lower lines I have in here. Now, we're talking about Irving Fisher had a mathematical process that he developed, became well known for. This black line is a mathematical process. It's called, this is actually a support line from the pivot calculation. So basically, there's math that says the standard deviation or the standard fluctuation in any given asset has ranges. There's the median, and then there's range 1, 2, and 3 that are higher, resistance, and then support 1, 2, and 3 lower that are support levels. And all I did here is I marked out the second level of support. As long as we fluctuate in this upper area, we're not too concerned about it. That's just kind of noise in the market. Once it gets down to here, now we're starting to get concerned because we could drop all the way back down to the 50 moving average. And we certainly want to be paying attention to whatever the news is causing this. Is this something that's critical? It's going to continue to escalate on the downside? Well, we go look for confirming data, because we don't know what's going to escalate and what is not. It's the confirmation. Now, while we've been doing this is basically large cap, and with the S&P 500, technology is a major driver, as it is with the NASDAQ. But RSP, small cap companies are very dependent upon being able to borrow money. So interest rates are highly sensitive to their profitability. In fact, even today, only about 40% of small cap companies are profitable. But we can see this trading range goes all the way back here into March, and it's just kind of been signs of hope and then disappointment have rotated over. But this month, we actually broke through major resistance levels here. And this, assuming interest rates continue to come down, it would not be surprising to see money move from expensive large cap into less expensive but profitable small cap companies, which is what driving this. It was called the large cap to small cap rotation. But then it kind of petered out in this last week or so, people getting a little more concerned about what the Fed's really going to do because inflation is not coming down. The key things that affect household budgets and businesses for that matter. I mean, businesses are not isolated from the cost of energy, the cost of commodities, which goes into everything, cost of transportation. They're all affecting the business at the business level. And there's only so much of that they will absorb before they raise their prices. The more expensive stuff is households become more conservative. They spend less money because they pay on essentials. Those are priority. And that can cause this boost that we've seen in this run on small cap stocks to roll over as people say, you really can't afford that. And that changes the economic outlook. But we don't know what that's going to be. What we do know is we can keep track of what's actually happening with the positions we own. You have anything that you want to add to that, Perry?
Correct. No, that is the critical part. That's the critical part is don't listen to the narrative. Watch what's going on. Follow the money, and that gives you the best probability of being on the right side of any trade and the right part of the market to begin with. And maybe more importantly, it helps you avoid the bad parts of the market. Not because you know what's going to happen, but you can monitor what is going on and react to that.
So one of the last slides we always have in our webinars is this is not for sluggards. I mean, if you want to be an investor and you want to sit back in your recliner watching Netflix or Amazon Prime movies and having a cooler in the summer, a warmer, whatever that is, cup of coffee or cocoa or whatever you may use to warm up in the winter, that's not the way you invest money on an active basis. Well, you can take what's called strategic buy and hold, close your eyes and pray it all works approach. That's what most advisors actually recommend. They diversify a little bit, but the pot never really changes with the market. It's not price sensitive or trend sensitive. It's buy and hope basically over a long, long period of time. And most investors really don't have as much time as they think to get their investment portfolio built up. But if you want to talk to us about your portfolio and about how we implement strategy decisions, give us a call, contact us, the phone number, the email, or here on the screen. Subscribe to our website. The subscribe button's down there, and go to the website and you can sign up for our next webinar where we do stock market update on the first Saturday of every month. Plus, of course, it's a holiday weekend. We do postpone a week. So go to the website. We'd be glad to talk with you, and have a great day.